And then they go ahead and they cut into it, and it turns out it's cake. It's like, that's what due diligence is for me. It's like, you're telling me it's an apple on the
That's
front,
great.
but you just sold me, a ton of sugar. And it's
Welcome to Numbers and Nonsense, episode number 9, I believe. I am Joe Nolan, and today Aaron and I are going to be joined by Marlon to talk a little bit about due diligence and entrepreneurship through the eyes of what you can trust and what you can't. But before we get into that conversation, it's time to bring the man, the myth, the legend himself, Aaron Holtzman, onto the stage. Aaron, how are you doing today?
I'm good, man. Episode 9, 369. Damn, we're fine. That's all I got to say right now.
Maybe one of these days we'll figure out how to do this, how to do a clean intro, maybe have people like us. Who knows? But let's not set our bar too high.
No, I relish the hate. It's what keeps me going.
Tell you, I know we didn't get a chance to talk about it on the last episode, but there was some pretty big news that came out of in the finance world. I'm sure you saw that my boy Jerome Powell cut rates 25 basis points about a week or two ago now. And they signaled that there's probably going to be another 2 cuts here before the end of the year. So we're looking at a new environment. When we're looking, Aaron, at interest rate environments, there was one from 2008 until about 2014, historically low interest rates. Then we had a really steady period of low interest rates before they started to climb. And then they were cut back down to 0 during COVID, and they were ratcheted back up with huge jumps. I know I watched the prime rate go from, it was like 2.75%. And today, even after the rate cut, it's 7.25% in just a 3-year period. What are your thoughts about the change to the rate environment?
Yeah, well, as someone that currently has a loan that is floating through the SBA, I'm very happy that it went down 0.25 point. I'm looking forward to a couple more drops this year. I'll say that it's going to firstly help people that have floating debt just make their payments that much easier. And then anyone looking to buy a business, it's going to make the debt service that much lower, assuming the purchase price stays the same. That's the thing that a lot of people always kind of forget, or the disconnect. Is the relationship between interest rates and purchase prices, not just in businesses, but also for homes and mortgages as well. When interest rates go lower, usually there's going to be an increase in the asset prices because people, potential buyers, both for a house or a business, have X number of dollars that they can spend to service the debt. And so, again, if interest rates are going lower, that means the debt service will be lower for the same purchase price, which will inflate the valuations. So we'll kind of see what happens, especially in the next year, if we actually go into a recession and how the economy is doing. Because obviously, if that happens, all bets are off when it comes to valuations. But if things stay, I don't want to say the same, but if there's no big kind of downside and rates have just kind of organically gone down, we could kind of see asset prices going up, both in the business world, valuation-wise, as well as the residential world.
Well said. No doubt about it. And I know we've got our project, 16 North Center Street, one of the deals we syndicated. We have a rate reset that's scheduled for the end of next year. And, when we're talking and when you and I are building our models, we're pretending the rate's going to be 8.25%, just to say, this is how bad it could be. If all of a sudden, we're at 6.25%, that's a ton of excess free cash flow that we have in order to reinvest into the property or do distributions for investors. So, there's going to be a lot of matriculating effects across a wide sector, wide swath of sectors here in the economy. And, we'll see. I think that the messaging right now is that the Fed is seeing some softening. So hopefully this shores it up by pushing more profits to, the people that own the businesses. And we'll see. I mean, I guess we'll have a chance to talk about this more as the situation continues to develop. But I think my big takeaway is that we're moving into a new interest rate environment, a falling interest rate environment. And that means that the businesses that have penciled out one way for the last 3 or 4 years, there's going to be a new way to look at these deals. So it'll be exciting to see how that evolves.
Absolutely.
Why don't you go ahead and introduce our guest today, Aaron?
Yeah. So our guest is the esteemed Marlon Balogh. He is a certified fraud examiner and a CVA. I don't even know what that means. He can elaborate a little more on that. But I've known Marlon for a number of years and have done a number of due diligence projects with him. And we'll get into a little bit of what that is. But Marlon, welcome to the stage, sir. Pleasure to have you.
Sincere pleasure. Thank you for having me.
So real quick, what is a CVA, by the way?
Certified valuation analyst.
Yeah. That sounds very complicated and I don't want to say boring, but nerdy. Wow. How hard is it to be to get those letters at the end of your name?
This is going to sound terrible, but it's actually not too hard. It's not too hard. If you've been doing accounting for some time and you're familiar with the ins and outs of business financials, it's quite simple. It's quite straightforward. So I would highly suggest actually getting it for a lot of people. It's a very good thing to have, even if it's not being used. It provides you some good information and knowledge. So highly recommend it.
Perfect. I feel like there's a collective breath of people that have failed the CVA exam. Just going, screw you right now. Saying it's easy, but
well, there's always a pressure point to something, and sometimes truth hurts. But yeah. No, as you guys know, like I do a lot of the financial advisory work. For me, it was the CFE was the most important one, which is the Certified Fraud Examiner certification, and that's because I'm mainly interested in forensic accounting and fraud examination. Right, that's how I started off everything. But the CVA really is just like a cherry on top, really, because I help a lot of M&A transactions where we just have to identify things that need to be adjusted, right? And that's where due diligence really comes into play, and its importance.
Well, you're, in addition to being a certified fraud examiner and working on due diligence for M&A for other people, you're also an entrepreneur yourself, owning a business and growing that. How have you been able to sort of leverage the insights, or what have you seen that you've been able to pull into your business?
I got to say that it's been a long time coming, and I've struggled with entrepreneurial that sort of mindset for quite a long time. Actually, one of my very first I would say publications was being entrepreneurial within. And essentially what I covered was, and I wanted everybody to understand was, if you work for a CPA firm or any company really at that matter, is that you could still have an entrepreneurial mindset and still be corporate or work at a CPA firm and bring in your own work. I know Aaron and I were very entrepreneurial where we were at our prior firms, and we went for it. We brought in our own clients and really just learned from there and how to market ourselves. And I think that there's a lot to learn. And I think entrepreneurial sort of mindset is something that you can learn with the right mentorship, with the right people, right? And those that really want what's best for you. So I really struggled with that for quite some time. And finally, it was this last December that I just took the complete dive into the deep end with my wife. And we have two companies now side by side, and both of them coming out of fruition from our past experiences and the things that we've witnessed in a lot of our engagements. And I could elaborate a little bit, right? So my main firm is Empowerment Advisory, where I do a lot of forensic accounting fraud examination work, which has actually turned a lot more into due diligence work, acquisition assistance work, quality of earnings. And that's a good about 50%. And I continue doing forensic accounting fraud examination work with small businesses, small owners, a lot of divorce work and you'd be surprised a lot how much forensic accountants are utilized as expert witnesses within divorce and assisting people with asset tracing, statements of net worth, marital balance sheets, as they call it down here in Georgia. But also the other half is the other side of the business when we deal with a lot of fraud. And that's where actually the second business has come out of. So a lot of the fraud occurs because, or at least a lot of the accusations of fraud occur because of the terrible or the lack of transparency of books and records, right? So when we're dealing with partners and other individuals and our books and records are not so complete or not so accurate, you end up with almost preliminary business divorce where people are like, well, I think you're stealing. And a lot of accusations come from terrible bookkeeping. And that's essentially why we created Happy Ledger, which is our bookkeeping and accounting consultancy practice as well. So having seen a lot of the results of fraud or the reasons why fraud occurs or accusations of fraud occur, we ended up also going that next step is saying we need people to have accurate books and records as well. So my wife leads our bookkeeping company and I lead our financial advisory company.
Yeah. And Joe and I talk about this a lot on the podcast about how having clean books and records and being transparent and having proper communication is what makes or kills a deal.
Because, 100%.
Yeah. And I mean, you make a really good point, regardless of whether or not you're looking to buy a business or sell your business, just from continuous operations. You want to make sure your other business owners or people that you're fiduciarily responsible for don't think you're embezzling money or, not being prudent with the money that people are trusting you with. It starts and ends with what you're actually saying you're doing and representing to them. But Marlon, I want to talk a little bit to dive deeper into the 50% that you're kind of talking about regarding the due diligence kind of process. What can you talk a little bit about what does that type of process look like and what happens during due diligence? And also for someone that's looking to potentially buy a business, when should they start talking to a professional such as yourself about doing due diligence? So I guess it's twofold. It's or threefold, if you will. What is it? Why is it important? What does the quality of work look like? And when does this happen? When does the conversation start?
Yeah. So let's just step back for a second here, because I kind of look at this in three ways. And the third way, I mean, we could put off to the side here, but there are two things in the due diligence before we start anything, right? There's the buyer and the seller, right? If we're looking at a potential purchase, right? The buyer essentially just wants to know, and it's kind of funny because I thought about this earlier. I was like, if you guys know the show, Is It Cake? Right? You guys know that show? And there's these hyper realistic cakes that are like made to look like a hammer, an apple, or whatever it is, right? Some sort of object or a hamburger. And then they go ahead and they cut into it and it turns out it's cake. It's like, that's what due diligence is for me. It's like, you're telling me it's an apple on the front, but you just sold me, a ton of sugar. And it's like, so from the buyer's perspective, it's like, that's what it is. It's like, is it cake? Like, that's the game we're playing right now. And the buyer wants to know if let's go back to the old adage, is trust, but verify, right? Like we see that you report these financials, but are the financials what you report? Like, is that the image of your company? Is that what it is actually occurring the past few years? But then due diligence doesn't always touch upon this, but also from a seller's perspective, it's we go back to that level of transparency, right? Accurate bookkeeping, right? Are we going to be transparent? Are we going to be forthcoming with information to the buyer? And so due diligence has both elements, right? And then of course we could go to the third level is, well, if you're a creditor, you want to know if something's going to be risky. And of course you're validating everything the buyer wants to validate, but you're also looking at risk at the same time. So let's leave the creditor off the table for now and just look at the buyer and the seller. Sorry, Joe, but
see ya.
Essentially everything the buyer wants to know, you want to know too. So, but plus the risk, right? We want to know just a little bit more.
Well, it is interesting though, because there's a lot of people, especially on the smaller side, I'm working in transactions less than $1 million sometimes, and people look, they do their own due diligence or they're working and trusting the bank to be their third party due diligence. But we are our own entity in this. We have our own incentives. So I often have to counsel people and, make the introduction to Aaron to say, listen, just because the bank will lend you money doesn't mean you want that money. Like you could end up paying the bank more than you're paying yourself. And that's going to be a 130 debt service coverage ratio. So that's a best case scenario, but it's easier to hide fraud in smaller businesses they can hide it behind incompetence when it might actually be malfeasance.
Yeah, and we don't want to, like, that's actually a really good point too, is like they could do their own due diligence, but it's do you want the bank loan if down the line it turns out, hey, there's not enough recurring revenue happening here for us to even cover that loan. And if they do their own due diligence, they might miss something that is really going to affect them in the future and down the line. And so that's why it's always important. It's great to rely on some of the underwriting and some of the controls that the bank might have, but really to perform your own due diligence with an actual expert is always the safest route.
It's great to have that third party validation, but to have your own theory of the case and your own understanding of how the cash flows between these different paper accounts is so critical in any M&A, especially jumping in midstream. If you don't know, you can't trace it, then you won't be able to replicate it.
Oh, for sure. For sure.
Yeah. And Marlon, you and I actually had a project a couple of weeks ago that unfortunately didn't really take off, but it was like at the very inception of due diligence. We had a great call. We were ready to, tag team the project. And our client, who was the buyer, actually flew out to this location. And fortunately, it happened early on before they really put a lot of money out there. All they lost was time and cost of a flight and a hotel. But unfortunately, they just want to get some very basic, like you were saying, Marlon, financial reporting just to tie out sales, to see what was being represented to them made sense. And, unfortunately, the seller just it was all thumbs and they couldn't produce anything. And again, deals live and die by how clean and, the financials are and how building that trust. And it's hard to build trust on a foundation that's in quicksand. So, fortunately for the person we were dealing with, Marlon, very early on, painful, but not as painful as it could have been. But I always like to kind of have our listeners kind of learn, hey, not how bad could it get, but this is the real world. It's messy out there. Can you give us, I guess, a little bit of it's almost October. It's almost Halloween time. Can you share with us a horror story, if you will, of frankly you doing a good job? I always I had this moment years ago in my professional career where someone said, like, what's the worst part about your job? And I said, you know what the worst part about my job is? If I do a good job and I find something wrong, everyone loses their shit and everyone gets angry and there's a lot more work that has to happen and everyone wishes I didn't find it. Which again, though, that's how the world of finance works is, people that trust us to uncover problems. Can you talk about a time where you did a great job and unfortunately it was bad? Not a bad outcome, but you did a good job and it was a negative outcome type of a thing.
Well, first, let's just go back and unpack our thing from 2 weeks ago. The thing is, we gave our potential client essentially like an arsenal of questions to complete like an upfront due diligence, right? To get us started on that process. And luckily we did give him the right questions and the right set of ideas to, when he goes to approach the seller, to determine whether or not this is a risky seller or not, a risky buy or not. And what I would say is it hits on the other side is that the seller's transparency was lacking completely. And it seemed as though they were afraid to provide such basic documentation and support for something that we were going to have to do anyway if the due diligence process went full speed. And so honestly, it wasn't unfortunate. I think it was a completely fortunate circumstance for this client because, it's just like you just dodged it. You just dodged a giant red flag, and these are the things that you don't want. And so my goal with every of our clients, Aaron, is to just educate everybody just purely upfront. If there's a way to help them and educate them and even have them save money up front, like, hey, here's a list of questions. This is what you want to do. And, educating our clients along the way, I think that that's the most important thing. And that's essentially how we do a good job, or we start our good job. But I'll tell you one thing is that a lot of these things end up with damage cases and theft of clients and things of that nature. So one of my cases a long time ago, I'm trying to think. They were attempting to seek damages, and this is probably a poor example. I know there's thousands, but on the spot it's hard to think of one. But we've seen so many issues where there was fraud. I'm trying to think of one. A lot of in buy-sell agreements, when we're doing valuation work, what we'll look for is, do these things exist, contracts, and when these things recur. So here's a damages case. I'll give you an example of a damages case we had maybe 4 years back. It was an IT tech solutions company, and essentially they were seeking damages because one of their employees had, one, siphoned off a ton of business, and two, also took a key employee along with them. So as you can imagine, I mean, this company is left with, one, without a key employee, and two, someone had taken a lot of proprietary information, client information, and things of that nature. And so what we found there is that, well, we're trying to conduct a damage calculation, but one of the key important details was, and one of the things we look at due diligence is the contract recurring, right? So when we're looking at due diligence work, we're actually looking at, is the client going to renew their contract, or is that a long-term contract that's going to go out at least a few years, and we're comfortable with that? But one of the things people forget to look is the history of the client. What is the likelihood of renewal as well?
Yep.
And in this instance, there were many clients that were either less than a year. The ones that were siphoned off were less than a year. It's unlikely that we would know whether or not they were recurring clients or not. So the damage calculation has to take that into account. So say they were suing for $2 million. Slowly but surely, we see that our tracing and our analysis of client contracts slowly start to diminish that damage calculation to lower and lower because of the quality of the clients that they've maintained. So they had maybe a few clients that were with them for the past 3-4 years, but their growth were all from new clients. So to state that whether or not those clients would have renewed their contract is difficult, right? So that's one of it's not a horror story, but when you're facing potential damages and recouping some of your losses, it's actually, in that position, it's quite scary, right?
Well, you kind of touched on something, especially for the professional services firms, but really anyone with, clientele that are recurring, that are not retail, I would say, which is the concept of what's called a clawback provision, pretty much saying, hey, listen, if I'm buying a book of business from you, such as I'm a CPA, I'm going to buy this other CPA from that has a $500,000 book of business, for, let's say, $500,000, and that book of business disappears the following year, I'm stuck holding the bag. So a clawback provision pretty much stipulates, hey, there's going to be an expectation that a certain percentage of the book is going to be maintained. Otherwise, the seller is going to be on the hook to recuperate the buyer. And that kind of aligns both the buyer and the seller with ensuring a smooth transition, making sure clients, renew with their new person. Because again, the last thing, if you were to be buying a business, especially where it's a relationship business, and everything is a relationship business, but some are more than others. Like a coffee shop is very different compared to a professional services firm. And again, you wouldn't want the ex-professional to just be totally MIA, and clients of theirs are coming out of the woodwork saying, hey, what happened here? And now you got to speak to someone else's work before you even took over. And in that case, at least they're still working with you. But in other cases, to what you said, Marlon, like they could go set up shop somewhere else and having non-competes, at least for a number of years, and all that kind of fun stuff. That's vital for specific industries. So, like you kind of mentioned, word to the wise, be aware of what you're actually buying and make sure to structure the deal as such to ensure that what you're buying isn't going to just slip through your fingers like sand.
Yeah. We had one client a while back, and he was selling his, let's just say, his intellectual property. And one of where due diligence kind of overlaps is, the development of more of prospective financials, right? What are we going to make in the future? What are we going to make in 5 years, 10 years? And how do we project these numbers? And essentially a part of the due diligence process with that client was, what do you expect revenue is going to be in the next few years? You can't just make numbers up. What do you have to prove it? right? So essentially it's verifying that, okay, well, these contracts are renewed, but also what long-term contracts are new to you as well. And this person was able to sell their intellectual property of upwards of $50 million because they were able to prove all these partnerships and sponsorships with all these companies and the individuals. And I think that that's very important is and just when anybody's purchasing or looking at a company, it's just ultimately the bottom line is verify, always verify. But things also come off, from, left field, you'll never see it coming. Potential lawsuits, divorce, you have to pry them about what unrecorded liabilities there are as well. It's like, you don't want to end up with a portion of your business owed to someone else all down the line. And that's a very scary thing. Someone trips and falls, let's sell our business today. Who knows? But that's a very easy, low-hanging fruit there. But you really want to just make sure that all your bases are covered. And I mean, that's why people would come in and hire us. So look, I once the letter of intent, and you had already asked this, when do they really need to come and find an individual like myself? It's always good to start the discussion early in the process, because again, I'll equip, and I don't know what other people do, but I equip our clients with a set of to-dos, right? A set of questions so that they're aware of what they need to look for and what they need to find. It doesn't matter what industry they're looking in, cafe, warehouse, manufacturing, fabric, it doesn't matter. We'll provide them with a list of information that they need to really conduct on their own. And that helps with the preliminary education. They should essentially know what they're getting themselves into. If they're relatively new to the industry as well, we need to educate them on our end. So preliminary discussions are always great. Once when that letter of intent is signed, I would say that that's when we're typically engaged.
Yeah.
And I'll tell you, it's so valuable to be able to dive in and verify, right? I mean, a quality of earnings report is really a gold standard that I can look for as a lender, as third-party due diligence that helps me feel confident about the numbers I'm looking at and the viability of them going forward. But, you never know what you'll find in due diligence. I mean, I've had deals that ended up getting eminent domained, 5 days before closing. So you don't know where the state could just step right in.
Was it Georgia?
It was in Georgia, actually.
Yeah, Georgia's really, really well known for that. Sure.
Yeah. I had deals where it turns out that the city was suing them to try to shut them down. Financials looked great, but the city wanted them out. And the broker said, if I thought you needed to know, I would have told you.
Yeah.
Due diligence can show up not just in the numbers, but also in the story. It's so valuable. A little bit of a different side is government contracting, right? Like that can be a very, very different monster, because you compare to, say, a cafe where you can look at past revenues and say, okay, these customers are likely to keep coming back unless there's a major change, like a highway gets blasted through the neighborhood and half your clientele are gone. But military contracting, it's all forward looking, where we need to discount the value of these contracts. And, all of a sudden, government contracts might not feel as certain as they might have prior to like Dodge coming in and being able to cancel them. So, when you're looking at things like that, like what do you try to, balance between like the upside and the downside? Like, how do you try to make like that internal decision of like, here's what the sum of all these pieces says? Yeah,
to me, it's if you know someone, let's just talk it out as a personal. If I know Aaron, and I know, and I feel like I know Aaron quite a bit, and he does very good work. If I send him a client, I know he's going to do good work. Okay, so the analogy here is, if I look at the past historic performance of the business, right, and I can verify that they've had recurring contracts, previous contracts, and they completed those contracts, and their revenues are looking good. They're increasing slightly year over year. There's no red flags. I could tell you that essentially I would turn towards a higher level of confidence given prior history. So for me, it's all about the prior history. Future looking, Past performance will determine future performance. And then I know that that's very basic and I'm sugarcoating quite a lot there, but that's how I essentially see a lot of this is past performance will determine future performance.
I like the other quote, which is if you don't know your history, you're doomed to repeat it. And it's funny because a lot of accountants, people say the difference between finance and accounting is finance is forward looking and accounting is always stuck in the past. And again, to kind of what you just said though, Marlon, you can't be looking forward without understanding where you came from. And again, especially if you're looking to buy a business and you're going, oh, they're having phenomenal growth, exponential growth, if you will. Do they build the systems to allow for that expansion? Or are they just kind of juggling plates, hoping to be able to just pass it off to someone else? I mean, again, numbers aren't going to illustrate that other than, oh, there's been a large amount of growth. Sometimes you kind of said it yourself, Marlon, that the financials can look great, but there could be intangible things that happen as well. And again, that's where understanding the business
understanding their company
profile. Exactly.
Yeah. Well, remember, I say, my tagline was the numbers don't lie, people do. But you're right. There's intangible things that we got to look at. Is who led the company, right? Who's on the board? Who's doing this? Who's doing what? And that essentially also kind of if you had experienced people in positions of operations, that's wonderful. That's great. I mean, that just goes towards the plus. That's in the plus bucket. But if you had, if they just hired someone who has new to the industry, no idea what they're doing, I mean, that's in the negative, right? So I would be, we don't typically weigh that quite a lot when we're doing due diligence because, again, we're looking at numbers mostly. But it is something to think about when looking at least management's profile and who's going to be continuing as key employees.
Yeah. And one thing just for everyone to take away that's listening as well, due diligence is not an opinion on it, whether or not this is a good business to buy. I actually just had a conversation with a prospective client who's looking to buy a nail salon in the Texas market, Houston, Austin, or Dallas. And, one of the things they're like, hey, so happy to have you work with us on the due diligence side. Can you also give us an idea if the valuation would be adequate or if it's a good business? And I said two things. I said, firstly, I can give you ranges on what markets would say for a valuation, but I can't say this is a good purchase price. That's ultimately up to you. And again, same thing for the business. Due diligence is very much, I liken it to just black and white. We said we were going to do this. We looked at it, and this is what we found. And we're not going to, and that has nothing to do with whether or not what you're buying is a good business. It's merely the business you're buying, the representations made to you on the financials, which is making you decide if it's a good business or not, are reasonable. And that's ultimately the big takeaway of due diligence.
Yeah, let me just add to that. So the due diligence process is essentially, is the business what it claims to be? So we're just reporting those numbers specifically, right? But if we're doing an acquisition assistance, it's kind of like due diligence plus, I would say. It's like we're looking at specific key risk areas. We're going to determine whether or not there's particular adjustments to be made to the purchase price, right? Non-recurring revenue is something that happens, some non-off event that we could kind of diminish or helps, adjust the purchase price. And then offering some sort of integration after the purchase as well. But that's essentially the acquisition assistance. And then I would say performing like the quality of earnings, just ensuring that those revenues are recurring and are going to be stable, at least in the years to come, to at least verify that is what is said, right? What are they actually reporting? So I would say you're right. We're not giving any sort of advice on whether something is good or bad. That's still ultimately the judgment of the purchaser. But, in my shoes, I would definitely say that it's something that we want to educate as much as possible. So for me, the education portion is if we're looking 3 years or 5 years, 3 to 5 years back, I want my client to know exactly what happened in those last 35 years as if they were running the show themselves. And essentially that's what the report should feel like as well. It's like we have a clear indication of how this company operated, and we're extremely comfortable, whether that's looking at revenues, HR related matters, their liabilities. I want us to have a complete understanding of things are as they seem to be.
Yep.
Excellent. Well, I got kind of something to put you guys both on the spot here. I think as I'm talking, it's interesting that we all see a lot of transactions coming in from different angles and from different perspectives. I think it might be fun if we each just went around in a circle and gave a couple of the red flags that we look for when we're first seeing a file come in, just to try to help our audience maybe start looking at deals the way we would. So, for example, for me, if someone has a debt schedule that is reporting that they have debt, but they didn't claim any interest on their tax returns, that's an interest. Okay, instantly, what is going on here? One of us is wrong. Or vice versa. They say that they had no interest, but they're reporting that there's debt on the company. Or is there unrecorded notes that aren't showing up with UCCs? Is there private debt that we don't know about and it's hard to trace because they're probably just paying it out of cash? Aaron, what's like a red flag you'll look for when you're first looking at something?
Yeah, I would say for me, it's going to always start with the top line revenue. Make sure that revenue ties out to sales tax reporting, to tax returns, or any other, I don't want to say third party, but any other documents you can try to get more comfortable with. Because also when we're doing due diligence, or as a buyer, you're looking at the business, you're benchmarking year-to-year financials and metrics, usually as a percentage of sales. If you understand what the gross margins look like, if sales doubled, you would expect cost of goods sold to also double. And if that didn't, the question is why? Same thing going for other types of, measurable metrics, such as maybe commissions or salaries. So I would say if your revenue is being overstated or understated, that could throw off the measurement of financial metrics all the way down.
So does the numbers match the story you're being told?
Exactly. And that's just the top line numbers. A part of the due diligence is to go through other numbers as well, but I always start with the top line.
Marlon, what do you think? What are some of the first things you look for red flags?
It's hard to make it go last, but
it's not necessarily red flags. I'll tell you something that I've noticed about small businesses, which is actually a conflict of interest, which I always find very, very interesting, because it's okay to hire family members. Right. And this might work towards the buyer's benefit, if you look at it a different way. But it's okay to hire family members. But if you're paying a premium to your family members and or their companies or whatever it is, like that obviously affects the financials quite a bit. And I would say that that's something to look into. But also, just piggybacking on Aaron, it's very interesting when you request the documentation you need, you'll immediately realize that sometimes you'll find some padding of contracts, meaning some contracts don't necessarily exist. And you're wondering, are the financials that you provided me the true financials? Are they directly from an accounting software? Are they from QuickBooks? Or can we identify these same transactions between the bank statements and your general ledger? And that's more of the forensic approach, right? We want to verify that these transactions did occur. And that's the fraud related portion of me coming out, is what conflicts of interest do I see? Are there any false revenues? Are the contracts manipulated? Or can we call the vendor? Can we call the client? Can we verify that they exist? Or are things being padded? So I take everything with more of a forensic approach, just because I'm just a lot more skeptical, and I've seen a lot more things than most people. So to me, I'm quite a pessimist or cynical about the whole situation, but in a good way that benefits the client.
Marlon, to kind of wrap all this up, we'd like to use this as an opportunity for our visitors to kind of say what their ask is. For people you're looking to meet, clients, or, not to plug it too hard, but I know you're also looking to potentially buy a professional service firm. So if you can just talk a little bit about, for existing clients, who are ideal existing clients, and who, if anyone listening has someone they can put you in touch with, who would that be?
Well, that'd be great. Yeah, no, I'm looking for mom and pop businesses, smaller partnerships that really need to make sure that their books and records are accurate and transparent. So I'm not necessarily plugging here my forensic work. Because I want to prevent fraud. I want to be able to help people prevent arguments and litigation down the line by providing clean and accurate and transparent books. I want to be their first line of defense. And so that's what I'm looking for. I'm looking for mom and pops, sole proprietors, partnerships that need some accurate bookkeeping. Even book cleanup would be wonderful work. So because again, I've seen the downfall of incoherent books, right? So that's what I'm looking for that. And then on the side also, and you just touched on it, that we're actually looking to purchase potentially an existing CPA who's looking to retire. A small practice would be wonderful. Anybody wanting to retire but continue working, that would be wonderful as well.
Amazing. And just in case anyone wanted to reach out to you or your wife, what are the name of those companies again?
So Empowerment Advisory, and the bookkeeping practice is Happy Ledger. And you can find us both on LinkedIn, Marlon Balogh and Jalisa Roche, Roche.
Perfect. Well, thank you so much for joining us, Aaron, Marlon. I think this is another great conversation. Now, I think we'll leave it here, and we'll see you all next time.
Thank you so much.
Thanks again, Marlon.
All right, you guys have.